Good morning, Double O student. Your mission is to disarm a bomb planted by the anarchist group and are counting. In order to do so, you will need to know about adjusted journal entries. Adjusted entries are required under the accrual basis of accounting. Remember that the accrual basis of accounting records revenues when they are earned and records expenses when they are incurred. Also, agent, remember that the adjusted journal entries never include the cash account because the cash account have either already occurred or will occur in the future. There are 4 types of adjusted entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. An anonymous source has told us that the anarchist group used either deferred revenue or deferred expense as their disarm code, so we will just focus on those 2. Deferred revenue is when a company receives cash before they earn revenue, by either supplying a good or providing a service. For example, you pay a magazine company for a 12-month subscription. On the first day, the company would debit cash and credit unearned subscription revenue, because they haven't provided the service of delivering you the magazine. The cash inflow is being recorded as a liability, not a revenue, since the company hasn't provided the service yet. Each month, when the company drops off the magazine at your house, the company will debit unearned revenue and credit subscription revenue. Since they have provided the service, they can now record the revenue. Now your liability account is decreased and your revenue account is increased. Now, agent, this is important. If the cash inflow was credited to revenue rather than liability, unearned revenue, then you will have to increase liability and decrease revenue by the opposite amount calculated in the previous example. In this scenario, the initial transaction will debit cash and credit subscription revenue. Then the following adjusting entry would occur. We decrease revenue by debiting subscription revenue $1,100 and then increase our liabilities through crediting unearned subscription revenue $1,100. The entry decreases the subscription revenue account by the amount not yet earned and increases the liability account unearned service revenue by the same amount. This shows the real amount of money earned in the period and the amount of money to be earned in the future. Okay, agent, next we have deferred expense. This is when a company pays cash before they incur an expense. A prime example of this is insurance. As the company doesn't use the insurance policy at a given moment, it cannot be recorded as an expense. Instead, an asset is recorded. As the asset is used over time, the asset account decreases and the related expense account increases. For example, a company purchases a 12-month insurance policy. This debits prepaid insurance and credits cash. The adjusting entry would then become debit insurance expense, credit prepaid insurance, reducing the asset account and increasing the related expense account. If the purchase was accidentally recorded as an expense, then the adjusted entry would increase the asset and reduce the expense account by the opposite amount to show the asset remaining and the expense incurred.
Created using Powtoon.